All right, welcome everybody to another Sunday Sync, or as Zuber calls it, the accountability group for Sunday, October 27th at 12:30 p.m. Pacific time. All right, let's open it up. Who's got what? Nothing? All right. Well, my wife, just on a personal level, my wife's going to go to ORAAT. Woohoo!
Nice.
Yeah, in February. So she wanted to go, but we were having trouble figuring out the kids situation. So we're going to fly in one of her friends from Utah to come to Oregon to watch the kids, so we can fly to Vegas. It's kind
Okay.
of weird, um, and we couldn't do the other way around because school and everything else. But anyway, so yeah, so now my wife's coming, so that's cool. She's kind of nervous about it because she's not really a social butterfly kind of. She doesn't do the real estate stuff, so but she's willing to come on board. So hey, ZB, how's it going?
Does that mean you're going to need to buy the ticket for me, or did you get one already?
I have to buy it. Actually, I have to buy a ticket. So
Oh, okay. Well,
I
let me
don't
know.
know.
I've got a spare.
Oh, okay. Well then, yeah, I'll buy it from you then. I guess.
Okay.
Cool. If that's what we're gonna do. I was gonna just go online and buy it. We just found out here a little bit ago. So
Oh, okay. Yeah, I was really hoping my best friend could make it, but I don't think that's going to be in the cards. Not this year, at least.
you're gonna make it though?
Yeah, oh yeah, yeah.
Oh,
I'm
cool.
I'm I'm doing my best. Oh, with all the overtime I just worked, yes, I think I am.
Yeah, yeah. I've been really kicking around the idea about buying a VIP ticket, but now I won't because my wife's going. I've been hearing a lot of people say, "Hey, get in the right rooms, talk to the right people," and I really do agree with that. But especially after meeting Pace, a couple weeks ago or whatever it was, and that was cool. Looks like we lost Ziwi. She came in and then left. Maybe her audio was messed up.
Hmm.
Oh, there she is. She's back again. Hey, Ryan. Hey, Mikey. Oh, hey, Mikey. I'm going to be talking to you here pretty soon. I'm talking to Mark on Wednesday about Pittsburgh. I because of pad split and their whole fee structure change, I'm looking at other markets, and so I was going to talk to him and then reach out to you also, Mikey, about Pittsburgh simply for cash flow.
Yeah, absolutely. Anytime, let me know. Mark usually sends like because he has such a good network. So usually people reach out to him, and then he sends those people to me
Oh,
to
really?
talk. Yeah, because he's he's so busy. He's so busy, and he's like, yeah, talk to Mikey, and then I usually just pick up the leftovers, and if they have any questions, I just try to help them out.
Oh, okay. Well, what I
Yeah.
wanted to do was I'm just going to come around and say it. I was going to try to see if you guys were cool with me leveraging your network and your whoever, property managers and all that stuff. I don't know. It's big, it's a big ask. I know.
No, absolutely. And if if you just wanted to talk and ask whatever questions you have, I can try my, I'm so new too, but if whatever questions you have, I can try to answer them. And yeah, I have no problem with that too. And I don't know if you talked with Jack Stewart.
I've talked to him, but not specifically about this. No.
Yeah, and he's another great guy too because he's like that's his market. So
All right. Thanks, man. I'm
yeah, sure, anytime.
glad I brought it up. Yeah, I've got a couple things that went through, and so I've just got capital sitting there doing nothing, and it's killing me. I figured if I could pick up a property out there and test it, pilot it, whatever, and then mainly, for the cash flow, but also the little bit of depreciation I could get from it because I'm trying to offset my W-2 income. So
Okay,
cool. Thanks, man.
yes, yeah, sure.
Hey, Z, will you get the mic or the audio figured out?
Yeah, can you guys hear me?
Yep, yep.
Mhm.
Okay, yeah. So it was really loud at first. I didn't know how to like adjust the volume till I leave and then come back in. Yeah. Well, nice to see you guys again.
Yeah.
Have been a little while. Yeah. So I have a few questions. I did meet with a couple of real estate agents who has investment background, and I went to investment group locally once, in October, early October, second week of October. So I have a question. I'm still like kind of a little bit lost. I was looking at my buy box, and in my area, my buy box is pretty much negative, based on, the interest rate right now, because we're in a college town and our house is, single family, it was pretty expensive per se. Um, So I met with the two agents. I just have a question because I think I posted the question on the school as well with the buyer agent. I like both of the, well, I met with multiple agents, but there's two agents I really like. I think both of them have property management themselves and they have investment property. One is a little bit small scale and she actually, only have single family as investment. And the other one has a lot of multifamily, like a lot of units. I think himself have more than 100 units. And he himself have a property management. So I like both of the agents. I just don't know at this point. I should let the agent know that I'm looking for. I'm talking to different agents. So you just be open with them, or I don't have to even bring up that conversation at this point because I think one of the agents told me that if I sign a buyer's agent's contract and it's going to be 3% because these days there's a new law for buyer's agent that you have to sign a contract or something started in August.
Yeah, you can do 1-day contracts or shorter. You don't have to do like these 3-6 month long contracts. You can do shorter ones. Like I said, I've even done a 1 day before.
Oh, really?
Well,
Well,
they that way they could show the property and be, legal or whatever they're doing. And I did that because it wasn't for me, it was for a friend here locally. I don't invest in Oregon, but we had to sign the contracts. I was like, can we do 1 day? And they're like, yeah, sure. So just FYI, but you probably want to do a little bit longer one. But I got a question for you.
yeah.
What's your appetite for, let's say, a 5-year loan versus a 30-year fixed loan?
I I don't know actually. So I talked to one agent and the one that he has a lot of multifamily, and he told me that he prefer commercial loans versus conventional loans. So I have to do a little bit more research on that. And he says it's much easier to deal with things like that, but I haven't really put in a lot of effort into researching that. So I don't know, like, you can give me some direction. Or for the single family, seems like it's just, I don't know, just easier. I don't know. I'm just like probably more familiar with the 30-year loan or 30-year, like conventional loans or fixed. Um, yeah. So maybe you have a lot more
Well, no,
experience.
nobody can tell you what, is right for you, depending on your goals. So
Mhm.
you have to figure it out, but people can ask you questions like, hey, if you had to refinance your, multifamily every 5 years, or I guess, I don't know, I don't do multifamily, but the point is unless you get, correct me if I'm wrong, anybody who knows better than me. But if you can get like seller financing, okay, cool. You can maybe get somebody carry a note, and then maybe you can have a longer fixed rate debt. And I know you can go up to 8 units with, I think, Convoy or Velocity or somebody banking gets as far as fixed rate debt. But if you get into the multifamily, typically you have to renew that debt every 5 or 7 or 10 years.
7 years.
Whereas, you get into single family, you can get that 30-year fixed rate debt, right? So that's why at least people like me getting into it, I wanted to do multifamily as well, as why I'm bringing this up. But what really scared me, because I've been through the 2008 timeframe and that, arms and all that, in my mind, it sort of sticks out as one of those. And people that are doing it now, obviously they're some of the people that did that like 1 and 2 and 3 year bridge debt, right? They're like, holy crap right now. But for me, it was like, all right, I wanted to do the multifamily stuff, but I like the idea of those multiple revenue streams in a property. That's why I did the rent by room thing, where I'm doing individual rooms in a property, so I don't have vacancy like the
The whole
long-term
house.
rentals do. Yeah, so it was kind of a hybrid. But I like that 30-year fixed rate debts. To me, that was like, holy crap, is the sweet spot. So that's the reason I was asking you the question, like, all right, if you are a person that likes to get things locked in and then maybe refi later, you might think about a single family or that type of, 4 and under, or maybe an 8 unit with Convoy or somebody. But if you don't like that, then going in that multifamily would be a little scary. Or if you're cool with that, well then yeah, it fits, whatever your goals are.
Yeah, and so the two agents have a two different kind of philosophy, I think. And over here, we're a college town. I'm in Iowa, so I don't know anybody from Iowa, and I would stay. And then one of the agents has single family, and she just said that, she doesn't really get any investment for multifamily, just a little bit harder. You only sell it to investors instead of, like first-time home buyers. If you have a single-family home, you can sell it to anybody pretty much.
Right.
But multifamily, it's like mostly just investors, and which you don't know for sure that at the time when you want to sell it or just in the future. Of course, you want to hopefully hold, but who knows what's going on. And if you want to sell it, that's going to be a problem, maybe.
Yeah,
So
I see it that way too. You got, I think it was Zuber or somebody said that, or maybe it was Ken McElroy. I don't know. So one of the big guys said that it's like jet skis, like boat. If you equate houses, the house would be a jet ski. It's very nimble and you can turn and get around and whatever. And then like maybe a small multifamily, a twoplex, threeplex, fourplex would be like a little bit bigger boat, that you can drive around. It's still fairly nimble. You can sell it to some. Maybe that's a bad analogy, but the big multifamily is like a battleship, or an aircraft carrier where they're really hard to turn, right? If you want to do something. So
yeah, and then she said that if you like have a multifamily, there's a couple of multifamily in Ames. I'm looking at seems to have a little bit better cash flow percentage wise. It's still pretty low, but it's been sitting on the market for a while, and I just I don't know because there's a lot of investors here, so I don't know why people not like. Must be a reason that people not really jump on it. They have been like decreasing the price, and as far as I know, they say, oh, it's you can't really rent out that much, and pretty much to combine it just like a single family home rental, and you also have to pay for the like I don't know, like snow removal, like things that you have to pay on top of everything else. So, but in single family home, you can just say, oh, you have to shovel your own snow and mow the lawns, whatever. But as a multifamily, you have to pay those things as well. So, yeah, I'm just kind of debating. I've been looking at the market and it's a little bit discouraging just for, with a negative. But she said the one that the real estate agent that who does single family investment told me that over here also with the appreciation of the property. So, but I don't know. I really want to count on that because our market is the house value seems to increase 30% from 2 years ago on an average
that's
basis.
an anomaly. If you look back in history, even Zuber says this. That's just a one-time. It's an anomaly. I think.
Is it happen to other places?
The timing, like the time frame.
Oh,
If I'm wrong, but with the government or whatever, with the inflation taking off, however you want to say it happened, inflation took off. Now, if they do it again, which I happen to believe they will, right, in a year or two or whatever it is, and then it'll take some time to get into the economy. Who knows when it's going to happen? But I actually believe they're going to do it again, right? I don't see a way out of it, but you can't bet on that.
mm-hmm. But I have a lot. I have a few friends who does single family investment I talk to as well. And their philosophy is completely different. They didn't even look at cash flow. They just say, oh, we just put it into for capital preservation, which is so I don't know. That's why I talk to different people and different philosophy. But of course they're paying for cash.
Right. Well, there you go. So like, you got to consider the source, right? Where people's goals are totally different. Like if you're a doctor making a ton of money or whatever, you're trying to get like tax write-offs, totally different strategy. Or, like I said, consider the source. Why are they doing it? Is probably
that's right.
Most cases is usually different than, there's big buckets, right? Like, hey, people want cash flow, some people want depreciation, some people want a combination of both, blah, blah, blah. But in general, everybody's different. Like, look at me, I'm the weirdest one there is. Out of state co-living investor, you know what I mean? Like, so everybody's got different goals. So I would definitely consider that. If you had somebody with similar goals to you might listen to them a little bit more, but pick up stuff from different people.
Yeah, that's right. And I tried to, kind of convince my husband a little bit, but then he just like basically tell me it's really hard to find a good deal because there's a layers. People already screen all the deals at the end of you looking online with the realtor.com. Those are not the best deal already that he said, oh, you wouldn't find a good deal. So it's kind of a little bit discouraging as well. I said, well, maybe there's still decent deals. I don't know, but I'm looking at the market. What can I do? Building, I'm talking to people and just building connections. I think that's what I'm doing right now.
Yeah, no, that's great. I will say that, like, back 4 years ago, I wasn't obviously a real estate investor, but I paid attention to stuff, refi my home, that kind of thing. And I got a 2.25 rate. Woohoo. But, things were crazy, right? Things were just, we
That's
had to
right.
buy a house once where we didn't even see it. Well, we saw it at 1 in the morning because it came on the market and we did a drive by and it was like half hour away, saw it. And the next day we put an offer, had to, because it was incredible. It was crazy. But now things are like my last two deals. The first one, I got 50 grand off the MLS. The second one was off market. But still, I think, like Zuber says, you can find, like the one I'm messing around with now. It's now on 82 days on market. It's been under contract twice and fallen off. And I kind of dismissed it, but then I told my agent to tell them to leave the offer open in case they come back to us, that kind of thing. But I think there's deals out there,
Okay. Yeah. Yeah.
especially now.
Yeah, I think I'm still like very even that one of the agent told me that she said definitely you want, it's a good time for the next 3 to 6 months because
Yeah.
if the interest rate kind of like go down, there's going to be a lot of people want to jump into, buying a house. So I think that's why I'm just really debating about the buyer's agent because one is multifamily and he has I don't know if he's had now the knowledge about the multifamily and the other one is a single family. She knows a lot about single family. She tell me, oh, you don't want to get this one because this one is close to like a low income or whatever area. So the resale value is going to be lower. So just seems to have a lot of knowledge. Then now I'm just like really debating, should I have, two agents? Should I let them know? Because they say you're not really supposed to I don't know. I mean, I knew that you're not supposed to tell people, oh, you're working with multiple agents, and the agent just doesn't really want to put full, like fully helping you,
Mm.
with buying a house or finding the deals. I don't know any suggestion or select buyer's agent. And my sister, she didn't even use a buyer agent. She just go to the listing agent. She said, oh yeah, I'm just going to a listing agent because then you can have a better negotiation if you know what you're doing, but I don't know whether I'd be comfortable with that.
I
Was
don't
my
know.
first.
I know that for me, I do that too, but I think, again, consider the source. So if you bought a house before, there's certain things, the high level stuff, like for me anyway, I got to make sure if I'm doing something, I got to make sure there's a contingency, like 10-day inspection at least, so I can back out if something goes sideways, or the loan, let's say your financing falls through, those little contingencies, you got to have those in there. Like if you have a contract and doesn't have those in there, you initiate it, boom, now you're under contract, you don't have any way to back out, you're locked in, right? So you got to know little stuff like that. So maybe have you bought a house before with your primary?
Yeah,
Okay, so you've done that at least, right? So you have some.
I don't really remember anything, honestly.
Okay.
Yeah, I mean, I kind of have a vague, like memory about things, but I think my agent back then helped us through the whole thing, so I didn't really need to understand most of the thing.
Yeah. Well, there's
Yeah,
some tips and tricks you can do, especially if you get an agent like that who's an investor. Is that agent an investor?
both the agent are
Okay.
investors. Yeah.
Yeah. Well, I was going to say, I think statistically, people can chime in if this is right or wrong, but I think statistically speaking, I would guess and have heard that most people that start off in real estate investing start with single family, just because of
Okay.
the learning curve, yada yada. Now there's those like Cody that goes out and buys I think he had a single family or whatever, but he jumped right into a big multi-unit thing. Good for him, and young kid and all that. And there's people that do it. Don't get me wrong, but I think most people would probably say most people. Now, whether that's good or right for you, I don't know. I'm just saying that's probably the average, or the most people start with single family.
Yeah, that's what I heard most of people, at least just have a few investment properties, tell me that's probably a little bit easier to deal with. At least you don't have to deal with tenants, like having problem with each other or something like that. Single family, you just rent it out to one entity, or
Yeah.
they can figure out themselves. Yeah. So
Cool.
that's it.
Cool. Any
That's what I'm right now.
No, okay. It's a pretty light crew today. We're 20 minutes in, and there's what we got: 1, 2, 3, 4, 5, just 5 of us. So Ryan's out doing his walkabout. Mikey's. Are you in paradise or where you at, Mikey? You in Japan? Or you in Hawaii? Or
He's so far away, the sound doesn't work.
Sorry, sorry, guys. I'm in Hawaii.
oh, nice. Nice.
Yeah.
Did you hear Zuber's podcast today? He said that's the most expensive place to retire. So
Oh yeah, that's the truth.
And I have a quick question. I'm like watching. I purchased a course from Women at a Time. So I'm looking at the seller financing. Very interesting thing. And they say seller financing is not what you can find, is what you can create. And anybody who has some tips and how to find, because I was playing around with the Bride Investor. I think Zuber and whoever is the creator for that app, the guy, and it's very interesting. You can search for different like the houses who the owner is out of state or things. It's very interesting, but it took me a really long time. I felt like I was getting really dizzy after using that app, and I didn't know I'd go anywhere, but it was just really fun to search about who owns the property and who is the owner. But anybody who has stories about seller financing, how you guys find out those deals?
I'll throw my hat in the ring. I haven't had a chance to explore that tool. I simply was looking at units that were on the market more than 60 days. I was looking at the selling history if it hadn't been sold or bought, in at least 15 years. And then I would have, I'd have the agent kind of inquire, how much debt they had on it. Um, the other thing I did is because I just did my first seller financing is I did end up getting a mixed use unit. So it's we're converting it into a residential duplex, but right now it's one commercial office and one apartment. Um, and obviously you can't get conventional loans on those. You have to go commercial, which I think scares off a lot of people. So that was the other to me that was the other flag. Like, so it's been on the market a while. It hasn't been bought or sold in a while. The buyer bought it. The buyer bought it in cash, or they haven't. The mortgage has been mostly or entirely paid down, and it's it was a type of asset that was difficult for most people to, or most people would be intimidated by trying to finance it. So, food for thought.
Thank you, Chris. And another question is about, just one other multifamily agent, or like multifamily investor, like agent told me about the conventional loan, commercial loan, and he actually told me that commercial loans is much easier to deal with.
All day long, true, absolutely. But literally, I would tell you, commercial loans are better in every possible respect. You build a relationship with the local bank. Once you get your personal financial statement in the first one, in some cases, they're bringing me deals or introducing me to other investors who want to sell. The amount of pain and suffering to get the loan through after the first one is ridiculously small. They're very easy with pre-approvals. All that's great. The only thing you got to be comfortable. And by the way, I was getting roughly the same rate I would get on a 30-year. And I was not, and they were not pushing me hard on how much I had to put down, different than a conforming, not as owner occupier, but as an investor. The only, and you used to, not in the last 2 years, but used to be able to do 5, 7, or 10 year. Most of mine are commercial, but they're 7 or 10. I think I have one 5-year. But the risk factor is you got to be comfortable with that 5-year reset. So the interest rates I was getting wasn't much different than market. So worst case, if the period ends and I have to refinance, I'll probably get roughly the same rate I'd get if I went into a 30 at that point. But but there's a risk, right? You have a 5-year, you're only protected for 5 years, right? So you have to kind of play the cards. Like, I looked at it and said, look, the rates had already started to go up and now are starting to go down. So do I think my first one expires in late 26 and the rest expire in like 28 or 29 or I don't know, or something like that. And so, I think that my risk of getting in a worse position, even if I'm a little worse, I can handle that. Um, but all that being said, like, I also, when I started going down that road, I wasn't aware you could do 30-year. I wasn't aware I could do 30-year debt on non-conforming assets, like more than 4 units or something that, you couldn't use conventional 30-year loan for. So I will probably pursue that as I get closer and the interest rates come down. I'll probably try and flip it into a 30-year, non-conforming type of debt, but I haven't done that yet.
Is that through Convoy, or do you know who's the lender on that for the 30-year fixed rate on multifamily?
Uh, I I think it might be. I mean, it's what Zuber talks about.
Oh,
I think it might be Convoy, but I haven't really gone down that road because the interest rates. I still think I don't have to pull the trigger for another 2 years, and the interest rates aren't really attractive yet. So as we, if once interest rates hopefully get down in the fives or something like that, I'll probably look to convert some of it.
yeah, that's awesome. I think they said up to an 8 unit. I could be wrong, but that, you know,
Yeah, nothing for me is large. None of mine are larger than 8, but I do have one or two mixed use buildings. So I have to see if they'll cover that.
yeah, that's a phenomenal thing. I've seen some around here. They don't work out anyway, but they're like 6, 7, 8, units. So I was like, man, that'd be cool to pick those up for a deal and get fixed rate on it. But
Yeah,
numbers just still don't work. So
I would say if you've got an attractive day job, right? If you've got a decent income, and if you oh, and the other thing is, conforming loans, you can't do, like the commercial guys will do construction loans and they'll kind of, you can do all that stuff, right? So just gives you more options. But I would say if you've got a decent income, and especially once you've got a little bit of a track record as a successful investor, like, hey, I bought properties, they're cash flowing positive, maybe there are or not, you've gotten some equity growth. Um, I would, I'd find like Matt says, right? I'd find a local bank. Don't These national banks are criminal. I'd go to a local bank, something that's got like 1 to 2 billion of assets under management. Like here in the southeastern PA, there's ACNB. There's a couple like at that. ACNB is the one I do most of my stuff with, and I'd reach out to the commercial lending and say, hey, here's my situation. I'm looking at making some investments. I'd like to consider partnering with you guys. Um, it you know, you're building a relationship, right? And if you are going to kind of eventually continue to grow your portfolio, and especially if you want to get into larger assets, um, above four, it's a great time now to kind of start to build that relationship. They're probably going to be easier to talk to now than they will be when interest rates drop and we're back in a buying frenzy.
yeah. Hey, did you start with single family and then roll into multifamily, or just start right multifamily?
Kind of, sort of. Like my wife and I, we would buy a house, we'd move into it, we'd fix it up ourselves. We'd live there for, 4, 5, 7, 10 years, and then we'd take home equity out, and then we buy a bigger, larger, nicer house. I mean, it was driven less by investment and more by like, we're like, ooh, we don't like the school. The younger schools were great. The high school's not so great. Let's move to another area. It was driven by that kind of stuff. And then, we'd rent it out. They were all alligators. At best, they were break even, but most of them were alligators. But eventually we sold them and we got massive, we did get a nice cash out at the end, no doubt. Um, so I would say, yeah, but not as an investor. Kind of just as a delayed seller, frankly. And in fact, we sold our last, and we never had more than one or two. We just basically we typically own like the last house we were in, and then eventually we'd sell it. So I would say I held single family homes and rented them out, but not as an investor. Certainly not as a good investor. It wasn't until we ditched those and I got into multi-unit and started buying for cash flow, and that's
That
when things got much better.
Yeah, that's what I was getting at. Is like, okay, it's for somebody like me who was interested in multifamily, I figured I'd get a base, do these homes, get 3, and then I show for a year. I was told that I need 2 years of tax returns to even start, maybe 1 if you get the right bank. So that's kind of what I was asking. It's like, all right, well,
Yeah.
my track record show that I'm good with money, good with operating, but it's a different class. It's a different asset class. And so I wondered, like you were saying, that the only part that
Well,
translates into multifamily is your track record. At least you did something. Yeah.
well, what is interesting, because I actually got rejected by Convoy once when I tried to, I think it was Convoy, when I tried to apply for a loan, or maybe it wasn't Convoy. It might have been a different, but my taxes are complex. My day job, I'm a partner in a firm, and then we have these assets we bought, and we did accelerated depreciation, and we did massive investment, and like they actually rejected me for something, and I ended up having to go with a different lender. But I did ask the commercial guys. I said, hey, like if I normally think to come to you for like 5 units above, or mixed use or mixed class or whatever, and I'm like, if I brought you guys like a single family home deal, would you do that? And they're like, we'll do anything as long as we're not going to do stuff that's crazy small, um, but we'll do anything that's a good economic opportunity, right? So, like I was looking at a large single family I wanted to buy. Now, eventually, I wanted to convert that into a duplex, and I looked at another large place, like a nice finished home that I was actually thinking about going down the short-term rental. It had already kind of been done up by the person who lived there, and I was going to convert it. I was going to kind of treat it as an STR, and they said they'd do the deal. I didn't end up going down. I didn't end up pulling the trigger on either of those, but anyway, food for thought.
Hey, Brandon, I like wherever the hell you're at right now. Where are you at?
This is home.
Oh, okay. That's in Texas
Yeah.
with palm trees and everything. That's cool.
Yeah, a little bit of palm tree. That's my background. I like the look of Hawaii, as you can guess with all my Hawaiian shirts, but I try to make it look like Hawaii.
Yeah, Mikey's like, I got the real deal, haha.
Yeah, that's right.
But then again, my guess is Mikey's probably paying a little bit more for that, haha.
That's right.
Hey, Mikey. Okay, this is bad joke time, so everybody plug your ears. I heard they outlawed laughing in Hawaii.
I didn't hear that.
Yeah, it's they reduced it to a low ha.
Oh man,
So bad, dude.
dude, that's
Horrible, horrible. Anyway, all
I,
right.
I did want to ask, for Chris, for the commercial, how do they look at extensions?
Haven't done one yet. You mean extension like a follow-on loan?
Yeah, if like you're in the tens and then maybe the market isn't looking good, then how would that work if you would ask for an extension on that?
Well, let me make sure I understand your question. Like let's just say like my first loan I did, or one of the loans, I forget which one, is a 5 year. Let's just say that loan was coming up next year.
Mhm.
They would probably offer to put me into another loan at the current interest rate. The part where it gets a little nerve-wracking is they would obviously rerun the economics on they'd probably get it reappraised, because they'd want to know that they're still sitting on they're still sitting on at least 20 or 25 or 30% equity. And they'd probably relook at the cap rate, or said differently, they'd relook at, am I going to be able to hit their debt service coverage ratio? I think their targeting is, I think it's like 1.25 or 1.3. That's the risk, right? I haven't done that, so don't know how that process would work. My hypothesis is most people are going to be fine on equity unless you radically overpaid for a short-term rental. That's a whole separate ball of wax. The next question is cash flow. I haven't actually rerun any of the numbers. What I'd probably end up doing is I'd probably end up trying to take some of my liquidity, and maybe I'd have to pay down the loan a little bit to get it back in the box if I was in trouble. I've done a lot of work in these properties though, to like, they all started like somewhere between break even and low to mid single digit cash on cash, and now they're most of them are kind of going to be in the teens. So I can probably take a little bit of a hit. But I mean, worst case, could they do extend and pretend? I think that depends on the broader market. I suspect worst case they could force you to sell, right?
Okay.
But I think that would be a bit of an extreme case. I mean, I will say this though: if you're on the edge, if you have older debt that's low interest rate and you're kind of living on the edge, like I think some of the STR folks are, I mean that you got something serious to worry about.
Okay, thanks. I was always curious about that. Thank you.
Yeah.
Wouldn't that also be an opportunity though to look at some kind of a portfolio loan where you take ones that have debt that's coming out in a year and debt that's coming out in 3 or 4 years and
That's a really
aggregate
interesting
it?
question. Yeah.
Because then you can be like, well, this one's ugly, but this one's great.
Yeah. So the question is, would they net it out? It's a great question. I don't know the answer. I'll actually ask I've become really good friends with the banker. He actually brought me a deal. It was actually his personal deal. I had to buy it through another bank because, obviously he was conflicted, but I'm going to try and have coffee with him next week. I'll ask him about that. That's a great question.
That's sometimes how the car dealership will package loans for people that you're just like, wait, they got financed? So.
Yeah, Henry Washington's a big proponent of that, talking to bankers. And, I think Zuber said the same thing. Well, banker brought him and he got a pretty good deal on it. But yeah, Henry Washington said to create those relationships now. So when those pain points are coming here in, the near future, you'll have that relationship built and who knows what'll happen. And I'm new, so I don't know what I'm talking about. I'm just regurgitating what they said, but I can tell you just in my little market and just my little amount of properties, that third deal I got came to me just because I was in the market and in that kind of thing. So that type of stuff can happen. So I think it's awesome.
Yeah. What I want to start, what I've kind of been starting to press on a little bit is like, hey, like, now I think they're pretty savvy. Like they're pretty calculated, right? But I said, hey, if you guys ever come across anybody who needs to get out of a deal, right? Let me know. But I will echo the point that, like, look, if you either have a good track record or you've got a decent income to start with, like a decent personal income, which makes you a much lower risk because you've got, for lack of a better word, the equivalent of like cash flow reserves, right? Now's a great time to start at least talking to them.
So Ziwi, for you, just like me, I was considered a novice investor. If you're like, I think what they told me was from the time you first purchase your first investment property, it's like at least 12 months. If you're under the 12 months, you're considered quote unquote a novice investor, and they're going to ask you for a little bit more down or do a little bit more digging, that kind of thing. And then till your 1 year mark. So, and then if you have a good broker, like I had a good broker, and she, even though I was under the 1 year mark for the third property, I still had to pay quite a bit down, but at least we got the loan. But Z had asked, can she get commercial loans on single family? And so I responded with yes. I have two that are DSCR loans, debt service coverage ratio loans, so you can.
Thank you. But you say like putting more means you just mentioned in the chat that 25% down, just like kind of like 30-year fixed or whatever investment loans, because then you pretty much required to do 20 or 25%. Down,
years ago, it was you could do like 15, and even up till about 2 years ago or a year and a half ago, you could do 15 with the right lender, and then everything went sideways. And so then it was you got to at least do 20 if you're an operator, I guess. But for me, because I was a newbie novice, they said, hey, 25% down. And then I came back to them a month later and wanted to buy a third one, and they're like, dude, you haven't even paid taxes. So I had to put 30% down on the third one. So just and things are tight. And I can tell you, even in the last quarter or two, like I've done 3 houses in a year. And the first one was like, okay, some paperwork. And then the second one was like that much paperwork. And then the third one was just stupid. I mean, they're getting super tight, digging into turning over every stone because they know things are getting bad. And so just be prepared when you go to do a loan, man. You're going to sign a lot of papers.
I'd say some of the advantages, and so that everyone knows my background, I was the vice president of commercial lending of a local bank. So I'm coming from this with experience of that local banks, there's an advantage. Sometimes it can be easier but I've also seen where they can change terms when it comes up for renewal. Those are some of the disadvantages. And locking in a 30-year rate, there's lots of advantage of that not having to requalify, because that's what you're going to be doing when you're coming up for renewal. No matter what that banker says, you are being requalified at the renewal. Not saying it's bad. I was in that industry, but you are being requalified, and they might change the terms. They might ask you to put more money down again. That rate could go up. A lot of times it doesn't go down a whole lot. So I'm from that, and I try to get out of that. I want to stay with 30-year fixed on most of mine, and I don't have that on every one of mine right now. So I'm in some of that, like Chris is. I'm in some of those local bank financing, but I also know how it works. And I will say I work those bankers pretty good too. And there's advantages, but they're tight. Jared, you're saying exactly what I was going to put in there, responding to yours. I was seeing the local banks here getting to 30 and 35% down as they're getting tight. So those are the things. Yes, there's probably a little bit less paperwork most times, but you have those disadvantages of the rate fluctuating at 5-7 years. I know here, Chris, all we're seeing is 5-year locked rates. I'm not seeing anything in the 7 or 10.
Yeah, they stopped offering anything over 5, like I don't know, 12 or 18 months ago for us.
Yeah. I knew of one loan that we did this was for a church. This was a special program they had. We locked in for 10 years, but that's the only one I'm aware of. Everything that I'm seeing around here is being locked in at 5 years.
Yep.
This is sort of for Ziwi here. This is tangential. I don't do it, but I have talked to Cody and I've talked to Christian from multifamily. I know they're separate, going separate ways, and I've talked to a lot of those multifamily guys early on. And if you spend time networking, talking to the owners, like a lot of people will do the thing, well, they'll look up the multifamily in the area they're interested in and say, hey, I see you have this property here and I'm looking to get started. I'm just curious of, how you did it, how you get started, have coffee, start those conversations. And then, who knows, a year or two later, you still keep in contact, those sort of things. Some people hear of things and then things might come your way. So you might try that, as long as you said you're networking right now, you might throw that into the mix, and then potentially, I'm not saying it'd be true, it would come true, but you hear about it all the time where someone says, hey, I got this thing, they're willing to carry a note, seller finance to you, and you're like, oh, cool. So those are cool because you can do those, you can work out your own terms, like 10-year balloons, 15, maybe if you're lucky, 20, whatever. But you might get into multifamily if you're pursuing that through non-normal terms, through like seller financing kind of thing.
Another thing I would suggest on that local bank side, I've shared this, maybe it was in this group, trying to talk about the psychological side. Bankers are risk averse. That's why they're bankers. And we are more risk tolerant than bankers are. So knowing that, what I typically do is I'll get with them. I'm trying to get ahead of the project, and I'll usually be 6 months, a year out before I know I'm going to be making a request. And I'll go meet with the banker and say, hey, here's what I'm looking at doing. What do you think? What would you require? So that also then how to structure it when you go back to them for the request. But in some ways, because they're giving you counsel, they're bought into the system. Sorry, I got my cat here. But they're bought into you already asking them, and so they're vested in it. But you're getting ahead of time what they're going to look for, what they're going to require, and if you're following through with what she or he was saying. I've got one of my bankers. It's one of my friends from high school. They tend to be more open and it moves smoother because you've gotten with them ahead of time. And in a sense, you're not blindsiding them with a request because they're just so risk averse. Blindsiding them sometimes doesn't work well because they knee-jerk react. And that's what I've found to really help in my commercial local product requests is I get with them 6 months to a year out every time and say, hey, here's what I'm looking at doing. What do you think the structure would be? And in some ways, they're giving you their structure, but then it allows you to know, hey, if it's not a good structure for you, you go shop it with another bank. Because now you already know that bank's structure. You can go say, well, here's what so-and-so is willing to do. Can you do something without actually getting denied? It's a very slow, easy, soft way to go find out who's got the best terms and best opportunity.
You guys are. I add one thing. You guys are making me think something. The last thing that has kind of come to mind for me is I originally thought I'd be working investing for another 5, 6, 7, 8 years, but suddenly now I'm contemplating a career shift, maybe backing out of my day job, like in the next 12 to 24 months. And I will say that has given me a little bit more nervousness because part of the reason I think the bank was comfortable with me is because, I had a good day job income. So I, for lack of a better word, I had some redundant income. And, if you know, the refinancing, based on why they're giving you the debt, whether it's your personal wealth or your day job or whatever, it's making me a little nervous. Like, 2 years from now, if I decide to retire next year or get out of my day job and maybe do this on a more full-time basis, like, am I going to qualify? Right. Because to your point, right, they're going to reevaluate me from a qualification perspective. And so I'll have to start some of those conversations now.
Essentially, aren't you guys talking about providing ownership to that third party that you're talking with? You're potentially saying, hey, how would you do this? Or you're getting that input, but then they have a certain ownership in it. So when you come back to them in, 4 months, 6 months, a year even, they're like, oh yeah, I remember that, da 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 da. How's it going?
Yeah, that's kind of what I was sharing, John, is that they get you're wanting them to be vested to some level into that request. And with it, if them, them giving you some structure and some saying, here's what we would want to see, in a way, it's making a little small part that they're committed to it, even before they have to be formally committed. I am playing the psychological game of sales.
Matt also mentioned something that, some of these banks, their charter or their key metrics they're somehow graded and or rewarded based on investing locally in the community, right? And so Matt made a comment about trying to kind of play that card with them as well. I haven't done that yet, but the other kind of another angle I'm trying to think about,
Matt nailed it too. I think he said what, 2 billion and under or something like that assets and no more than 5 branches. And in Arizona, I found that he nailed it because I had one that was 3.3 billion in assets and they had like 11 or 12 branches and they were like, because I haven't been through the tax returns, but I still didn't get it with the smaller banks, but at least they were more open and more willing to talk. They still said, hey, you have to have tax returns for your properties, but it was just a different vibe. And so, man, when he said that, I thought it was a general thing, and it probably was, but in my case, it was dead on. He was right. Like, no more than 5 branches, to under 2 billion in assets, smaller than what I was seeing. So I thought that was pretty cool.
I'm with right now 3 banks, and the one that's the best and easiest and best terms and structure is exactly what Matt was describing. They've got 3 branches and that's it. And that's the one I'm getting the best terms and best amortization. They're willing to go on one of my projects that I'm building right now, but they're willing to go 25 years if I want to, and all the structure. Now, it's not being fixed for 25 on the rate, but they're willing to do an amortization of 25 years. But they're the easiest to work with. I mean, I wholeheartedly agree with that.
Sorry, a side note for the commercial and the conventional loans, because when we start that conversation with my the agent, he asked me whether I want to form an LLC. And that's where I think he said the conventional loans, you had to under your name, right?
Right.
And but in LLC, you had to have commercial loans. That's why I think we started a conversation about the commercial loan, because I've never really thought about it. And I thought, like, in any investment that you should create LLC. Okay, that's what my question. Next question is, so what is your guys' take on for the LLC or created LLC for investment properties?
Here we go. Let's get our popcorn out.
I think the best advice is to listen. Dion's got a video out there to hear different perspectives. There's two different sides to this. I'm not even confident one side's right or wrong. I don't know myself, but Dion has a video out there I would recommend listening to. His is on not needing an LLC. There's lots of stuff out there on forming an LLC. I think both have valid arguments. And that's true. That's where I'm at, is both have valid arguments, but you can get 30-year fixed rate with DSCR loans in an LLC. So if you're wanting to get 30-year fixed on a product, it's out there for LLCs. If it's a residential type of investment, you can get them.
I have a question. I'm actually not sure. Like, everything that for me is commercial is in an LLC, and everything that's a conforming, conventional Freddie Fannie back loan is in my personal name. That I may eventually try and move into LLC. I don't know, but can you? I wasn't aware you could get a commercial loan through a regional bank type of loan that wasn't in an LLC. I thought they typically required that, but I actually don't know. Don't know if anybody has any idea on that.
What's the question again? Say that again.
If I took out a loan from, say, my ACNB, my regional $2 billion AUM bank, I just assumed it had to be an LLC. Could you get it in I mean, I obviously have to personally, guarantee, but could you actually take out the loan in your own name versus an LLC with that regional bank?
Absolutely, Chris. Yes, I've got multiple in my personal. I've got a combination. And that's where I'm riding the fence right now, because I don't have the perfect answer myself. So these are good, fair questions all of us are asking. So don't think, that's bad. I hear Dion's argument and I'm like, okay, yeah. And then I hear somebody else's and I'm like, man, I can see that too. I don't know. But yes, Chris, you can. I've got several right now just in personal.
Interesting.
And I've got some in LLCs with a local bank.
Okay. Wow, that's interesting.
So Ziwi, I will say one thing. I'm not going to say what's right or wrong. I have both also. But if you're buying a primary and doing a house hack, obviously you'd probably put that in your name and you're going to get better rates, right? Maybe 3/4 to a point cheaper than you would with a commercial. So I just wanted to throw that out there as just another piece of information. So, but I don't want to comment on either. And I'm also in this. This is a weird one. That's why I say get ready to buckle up, get your popcorn, because it's one of those things in this world that, and it also if you're doing in your primary, that type of thing, or if you have it under your own name, it's easier to refi. It's like I want to put everything into a trust, but I'm not going to do that until I get everything refied to a point where I want, and then I'll throw it all in a trust.
As far as I understand, so sorry, I'm new, like you cannot do refi if you're in LLC. Is that correct?
No, you can. It's just you're going to be at a higher rate. Right, Brandon. I mean, you can refi your DSCR. You can refi into a conventional.
You can refi with a DSCR and the LLC, and but I agree with Jared. The rate's going to be different. Sometimes it's like right now, DSCR is still a little lower than conventional, at least with Convoy right at the moment, but that's not always the case. In your personal name, boy, it is easier to refinance 30-year fixed rate debt. It is easier. With LLCs, you've really got, from what I'm understanding, two options. You can do a local bank or you can do the DSCR at 30-year fixed. That's your primary options with an LLC.
Thank you.
You didn't know you were going to stir that one up with that question, did you?
Well, that was the real estate agent asked me. That's the first question you have to think about. You want to go to the LLC, and then you decide whether you wanted a commercial or you want a conventional. So that's why I thought that it's going to be a quick, easy decision. Maybe it's not.
All right, what's next? What other juicy stuff we have to talk about here? Looks like John's still on. Oh, Mikey's unmuted. What's up, Mikey?
Yeah, I tried reaching out to a local bank, Dollar Bank, and I thought everything was going okay, but once I got into it, it's like the points were higher and even all the closing costs were probably like 5,000 higher. And they said I could only do I think thir three 30-year conventional loans with them. So it was the kind of thing where they made it sound good in the beginning, but as I got deeper into it, I realized they were just kind of throwing in a lot of fees. So I just went with my original lender.
Yeah, that's a good like me when I first started out, I didn't know any better. This is how I'm gonna be completely honest here. I just went with a big bank and thought that was it. And if they said yes or no, that was all I had. I didn't think about you can shop around. I know that sounds really, really dumb now, but I didn't know, right? And I'm like, oh, well, they said no. And someone says, well, did you try another bank? I'm like, well, no, and we'll do that. I'm like, oh, okay. I don't know. For some reason, I thought there was this big nebulous like bank thing out there, and they all had sort of the same standards because you hear about this is for a primary purchase because you hear about the Fannie Mae and they're all basically selling into those. So I thought, oh, well, it's all the same, but obviously not. So.
Are you guys sourcing your banks close by? Because I know Jared, you're investing out of state, but are you getting your bank loans and everything through your place close by in Oregon?
I've been looking in Arizona for those small banks because the local community where I invest. But the ones I've done so far have all been through brokers. Like part of that is I haven't used the same broker for a second purchase. The first one I did with the guy I knew who did primaries, and that worked out because it was a primary purchase and he's great. The second one was a DSCR, so I had to get somebody who knew that, and he was okay, but he was a little bit more expensive. But I didn't know what the hell I was doing. I got 50 grand off on the purchase, but then I not screwed up, but I paid more than I should have on the lending side. So then the third one, the porridge thing, the porridge is just right. The third one dude, I nailed it on that. I'm going to go ahead and toot my own horn. 120 grand off, had a badass broker, not too expensive. We closed in 10 days, didn't have a file on me and closed in, it was 12 days. Lauren Fisco is her name. If you guys ever in a jam and you want to do a DSCR loan and close fast, she's a beast. She's Jamil Damji's sister's broker. And so I don't know if you guys know Jamil Damji, but anyway, his sister's a big operator in Arizona. And I was in a jam and I was like, man, I need a broker that can close this. And I knew my broker couldn't do it. He says, oh, I can do that. I was like, dude, no offense, but I know in my heart there's no way in hell you can do this. And so even though I had a file with this guy, I still went with her who I didn't have a file with, and she nailed it.
I would also go ahead. Well, I was going to answer, Kevin, a question you had that maybe on local banks that they have to their lending requirements are to lend in their local area. They can't go outside of a certain trade area. There would have to be a specific reason why. So on a local bank, if you're doing local requests, you do need to find a bank in their local lending area. There are guidelines with banks on that.
Gotcha. Yeah, I'm out in San Francisco area, but I'm looking into San Diego right now. So I'm just
you would probably have to find a local bank there unless you have a bank there, a local bank that has branches down in San Diego. I had one request, and I'll just give this example. They had to figure out how to not get in trouble for doing a loan outside of their primary area. I'm here in Dallas, Fort Worth, and I had a request with them down near Corpus Christi by the coast. and they had to figure out could they do it because it was outside of their trade area. But it took them a little bit to make sure that they didn't get in trouble. I mean, I'm talking normal speak, but that they didn't get in trouble for doing a loan for me down in Corpus Christi, even though it was still in the same state. They had to figure that out with the regional manager to make sure that there wasn't any banking whatever guidelines that they were not doing. So I'm just giving you some things that I know enough to be dangerous. That's it.
And you guys were mentioning that. Sorry, I missed what Lumberjack was saying about regional banks and I had just joined in at that stage, but was there like a specific criteria that were giving the best rates?
He had some general guidelines, but I think they're better than general. And at least what I've seen is he said, I think under 5 branches. And Brandon, didn't he say like 2 billion or under, something like that?
That's what I remember, and I think there's a principle in it. I think the banking regulations on smaller banks, if I remember right, because it's been 15 years since I was in banking, so I'm trying to draw back some memories. There are different guidelines for different size banks, or they're under different scrutiny, if you want to call it that.
Yep. 10 billion.
Smaller banks. Yeah.
It's like there's branches that separate off legally because they're like 9.8 billion because they stay under that $10 billion cap. But I think the 2 billion, they're small enough to understand you and be, have a relationship with you and work with you, be more willing to work with you because they got to lend money, right? They're banks. That's what they're in business to do. And like you said, they want to do it in that community. But I think at least that $3.3 billion one, I think it was AZ Credit Union or whatever, and they have like 10 or 12 branches. It's like, well, that's close enough. And then they weren't really willing to play ball. So I think when Matt said that, he meant it more than in general. He knows what he's doing, right? So I think that 2 billion and 5 branches is a good target to start with.
All right. Well, what we'll start to do.
And I think most banks will publish that on their website. It wasn't hard to find what they had under asset. They like to brag about it, I think, or at least show that, hey, this is us. And it wasn't hard to find. All right. Well, we're falling off fast here. This might be a quick one today. Anybody have any other topics? Or
I was just kind of curious, is there a normal down payment for a DSCR or is it all about the numbers?
depends on who you are and what risk you are to the bank. Like for me, I was a high risk, and so I had to put 25% down on the second and then 30% down on the third. But then that was a single family home. I imagine if you're in the multifamily space, they're looking at more like what'd you say, Brandon? 35 and even 40% down. Hey, Brandon, you're on mute. Sorry.
I don't know on the DSCR. I know they're going to be probably at the very minimum 20% down on the purchase from what I'm hearing. It could be a higher percentage. I'm literally only having my very first experience with DSCR right now, but it's a refinance. So it's not a purchase. I don't know the purchase side very well. I've been talking to Jonathan, Yooo, Jonathan Yu at Convoy, but I'm doing a refinance, not a purchase.
When I was looking at DSCR, I think it was just all about the numbers. So they were looking at like 15%, 15 to 25% down, but the rental numbers have to work out. That's all they're looking at.
But that 15, you have a portfolio and you have a relationship with that bank, right?
No, this was just me doing initial research, and this is in Atlanta, so it's like it was a different market. So I'm not quite sure if
was
just numbers wise were
was
a little bit different. 3 months ago or so.
Wow, 15 reason. Wow, I haven't heard anybody say 15 for like a while.
Yeah, but I think numbers don't work out for most purchases that way because just unless you get it at a really low rate.
All right. Any other topics or questions or anything?
Kevin, I want to ask you a question about your DSCR research. And this is open discussion. You know, one of the things I was a little bit, I didn't particularly like with Convoy was they would not allow me to lock in the rate when I made the request, that you couldn't get the rate confirmed till right when you were closing. And I'll tell you, for me, here I'm spending all this money getting appraisals and all this done, hoping that the rate's right. And what's happened, I have not closed because the rates went up. And so here I just blew $800 on an appraisal that at this moment I'm not going to do. I didn't like that I couldn't lock in the rate, so I can't keep going with the loan. Kevin, were you finding in any of your DSCR requests that would allow you to at least lock like a conventional mortgage, where you could lock the rate and keep going through the process?
I didn't get that far in my research.
Yeah, I'm just
Okay,
wondering if
really.
that's a DSCR issue or not. I just don't have enough experience.
I was able to lock in both of mine, Brandon.
See, that's what I thought was just
Yeah.
odd. Was this with Convoy or
Two
with?
different, no, and actually those are brokers, and those I don't know on the back end who the lenders were, because they actually, I don't know if you guys have seen this, but a lot of those commercial loans are getting thrown to SPS, a servicing provider that you pay, and then they pay out the actual lender. But yeah, I was able to lock in mine. I wasn't happy with the rate. One of them was it was 8.1, and I bought down to a 7.65. Bought down to a 7.65. But yeah, I was able to lock them in.
Okay, that's where I was disappointed. I mean, it's like, why? I've never had that happen before on any loan request I've ever had, and he just acted like that's the normal way he's doing it. Is I couldn't lock it in at all.
Weird.
This is through Convoy?
This is Convoy.
Yeah.
Maybe it's me. I don't know.
Maybe it was that shirt.
It's
Sorry.
all right. This is a good looking
No, I agree.
Hawaiian
It's
shirt.
good, man. But just sort of blends in with your whole background there. You're like part of the canvas, you know.
They're not a fan of palm trees.
Sorry, man. I don't know where that came from.
Ran, since you're doing like building structures, like how is that considered in your loan process, I guess, or are these for separate projects of yours?
These last two, if it's talking about the DSCR, I don't do DSCRs on those. At least I haven't yet. Right now, I've got two going right now. We're pouring a foundation tomorrow. The other one is they're getting rough plumbing put in here the next couple of days. So it'll be about a week, depending on rain, 2 weeks behind. Those are conventional loans with that local $2 billion bank. And then I go to refinance them. If it's like the last one I just finished, I refinanced it with a traditional conventional loan in my personal name. What I do, because they're all in personal, I do have a $2 million umbrella policy, because we're doing LLCs for protection. I know this, maybe I should have brought this up, but I'm doing a $2 million umbrella policy, and I'm doing them all in my personal name going forward for the moment. I might change that. That's why I'm not definitive one way or the other, but I'm keeping them all in personal because it's just so much easier to refinance in better terms, because I know rates will get better someday. I want to be able to jump on that a lot easier than with LLCs. So does that kind of answer what you're asking?
I was just thinking about how like you were structuring or how are you getting loans, I guess, for like the build process.
Oh, okay.
Separate, you know what I mean? Like, because since you're doing you're building from ground up. Because I'm looking into doing like sort of a hybrid where I'm looking to purchase a primary and then essentially build ADUs on the back end?
Well, I've built multiples over the years, so I think that has a factor in allowing me to do what I'm doing now. I've gained that credibility because I know the first one, they're going to be definitely a lot tighter. A lot of the local banks will say, okay, I will finance it, but you need to put 20% down of the construction cost. I've gotten to the point now where I can negotiate with them, and I'm competing these banks against each other. And I've asked them, now they'll do one bank, this local smaller bank's doing 85% of appraisal cost, which has ended up being more than what I'm building it for. The other bank is doing 80% of appraisal, which is about right where I'm building it. And of course, I'm planning to put a little bit down, but that's the structure they've given me is 80 or 85% of appraisal when I'm building them with about 20% equity in the build. So I'm really not putting a whole lot down. And then when I go to the 30-year fixed financing at the end on a conventional mortgage, it's 25% down. And I created that video just a couple weeks ago, deciding in my head, do I want to put a little bit more money in it, trading equity for a little bit more cash flow? So I'm deciding I can do it with as little as 5% down on all these projects, but I'm deciding, do I want to put a little bit more down and just have a little bit more cash flow from the beginning, putting 15% down instead of 5. But that's the structures they've given me on my last two, actually the last 5 constructions. I've not had to put anything down from the beginning. But that's, I think that's from experience of just, I've been doing it for so many years.
Right.
Some of it's relationships, and you're just going to have to know how small my community is. I grew up right where I'm doing all these. One of my bankers, literally, we were in kindergarten together. The regional president was his daughter was my wife's best friend. Those relationships help. The other banker I've known for almost 20 years, and it's building those relationships also loosens it up a little bit too.
Are those being done as a double close?
On these last 2, I did it with 2 separate banks.
Right, but are you closing twice, or are you doing like a construction and a permanent, but essentially a single close?
No, just 2 closes. Sorry, 2 closes.
Okay.
So I'm doing a construction, and there used to be construction to perms, is what it was called.
Mm-hmm.
I have not explored that or heard much about that recently, so I don't know if that product's still around because I'm not hearing anybody talking about it. So these are separate ones. I have a construction loan and then a separate permanent with another lending institution.
Okay.
Hey, Brandon, I know you got to reach back in the memory banks here, but the banker's mindset. So let's say you get into you want to get a loan with the bank, small, $2 billion, whatever under, and you're buying an investment property. And let's say I'm to the point now where I could do a 20% down. That's great. Given that the banks right now a lot of them are looking for deposits and struggling, do you think if I was to, let's say I'm trying to build a relationship and have that really solid foundation with a bank once I find one, do you think even though if I qualified at a 20, if I put in a 25 for the purposes of saying, hey, look, I know you guys need some deposits, some cash flow, do you think that would help, or is that just dumb?
Depends on, no, you're going down a good track. I use that too, because one of the banks was desperate for deposits. And I said, okay, I will give you deposits if you give me the structure this way. Because if you take the fractional banking, is what we're all on, a system of fractional banking, they can lend 9 times the average monthly balance of deposits you're putting in there. And I've used it against them with my own business accounts. Some of y'all know I do property management. Well, even though that's not my money per se, it's trust accounts. I'm like, I'll move you a trust account, and we're taking in $2.5 million in rent payments. how about I have this structure? Or if you got smaller deposits, of course I don't have that money, but I'm using those things to get them what they want. And I've asked them, what do you want? And one bank said, we need the deposits. I said, well, okay, then I need the structure this way. Let's do it together.
2.5 million. That's a hell of a leverage point. But for somebody, most of us are probably like me.
I agree.
Yeah, mine's like 24 grand. I would move deposits there if that helped me.
But 24 grand
monthly
times 9 means they can lend over 180,000.
Yeah.
So it is money that they can use.
Yeah. Now they don't have to have reserves. Can't they do 10 times the loan?
Right.
That's crazy.
No, but so you're thinking the right things, Jared. They do want the deposits, especially, because the last couple of years, the deposits were leaving the local banks. They were going to the big banks because the big banks were paying 4% and 5%. So the local community banks were losing their deposits. They couldn't pay that kind of money just because of the nature of who, their bank structure. They couldn't pay that. So the big banks were capturing all these deposits and they were losing deposits.
Yeah.
And I still think that's something you can use as a leverage tool.
Yeah.
And just knowing what's going on in the banking industry.
I was just going for one other point. The last loan I did with the bank I've got a great relationship with, they actually added a contingency that I had to have like 50 grand on deposit at time of close. Now I ended up taking most of that out, but eventually. But yeah, I think they're actually, to your point, they're definitely getting a little desperate for some cash. And I was surprised that it was a requirement of the loan approval. So
I had done that same thing 15 years ago when I was in banking. So that's what I knew that how to use it to my advantage because I was doing some of the same things, Chris. So that wasn't abnormal for them. That was kind of a standard practice in the industry.
So do you think, and this is totally selfish, but do you think the monthly deposits are more important? Or do you think if you had, say, 200 grand sitting in a bank account, you think putting that 200 grand in that bank is more powerful than that monthly turnover, or does it matter? I mean, what do you think?
They can lend, it's off the average daily balance. Mm-hmm. So if it's a smaller account where money's coming in and out, it has an average. If you look on your bank statement, it'll have that average daily balance. That is the exponential that they can use. It's not what's in for today. It's what's that average balances.
Okay. I just had another thought, man. I could, because I've got a couple $100 grand sitting in an IRA account. Now, I don't know if the bank would be able to do this, but like I'm with Titan Bank in Texas, actually. So if I needed to, I could use that as leverage with these small banks to move that money to go into the small credit union, let's say. But I don't know if they do because it's a specific retirement account, checking account. It's a checkbook LLC for SDIRAs, right?
Yeah, they might or might not have that product. Yeah. That's a product with that specific bank, possibly.
Yeah, that's why I had to go to Titan Bank in Texas because they were set up for that. So maybe the local credit unions won't have that, but cool. This is good, man. I like this stuff.
Now these are good discussions, and I'm trying to give what my back experience there and not give y'all bad advice of what I remember from banking. And I know it's changed some, but I talk banking with the bankers and I know how to even create the credit package for them. They make comments about yours are easy because you already do the underwriting for me of it because I know how they look at it. I remember I was the one putting those packages together and I put those packages the way they would underwrite it.
Man, I'm reaching out to you in January when I start firing bullets here. I have to wait for tax reasons is why. Cool, man. This has been great. We have
how do most banks look at that 50-40-10? Because is that something specific to Velocity, or I was just curious, like as a bank, like banks are kind of around.
I've never heard of anybody but Velocity doing that. So I don't know
Yeah,
what.
that's a
Yeah.
velocity product.
Yeah.
That's specific. Yeah.
But you're going to pay for that, right? Stephen Dowd, he's in it to make money. I mean, if you want to, that's cool, but just realize you're going to be, that doesn't come cheap. Like risk versus, you know, like even at the ORAAT last year, right? They were like, oh, this guy does this. You had what was it? I forgot the two other banker guys. The one Convoy was there. Mortgage
Matt,
money.
the mortgage guy.
Mortgage guy was there, and then Steven. and then somebody asked some off the wall question, and all of them went, talk to Steven. Because he'll do it, but you're gonna pay for it.
You know, one of the things that I talk with them, and I'm giving y'all some advice when you're talking to these lenders, your financial statement is your report card. And knowing that intimately, so what I do is I prepare my financial statement every 6 months. But then sometimes if I'm looking at projects, I'll put it into my financial statement and see now how does my financial statement look? Because then I'm looking at loan to value of my entire portfolio. Debt to equity ratio is another way of looking at it more from a business perspective, but I use that language when I'm talking to the banker. I think loan to value is a big thing that they're looking at. They're seeing how leveraged you are. And so just for my example, because I'm heading towards, want to be towards where Dion is, and he talks about this. He is using some of that language. When he's retired, he wants to be at around 50% loan to value. That to a banker looks real secure. But if your loan to value, even if you've got 10 properties, but your loan to value is 85%, that doesn't look good to a banker. Even though you've got 10 properties, they're looking at you are highly leveraged and you have very little bailout off ramp. And so I'm looking at that and Dion mentions this being bankable. I've sent him a message. He's saying the right things. As you're doing these loans, you've got to realize you've got to stay bankable with these bankers all different ways, because I see people doing quick loans and they don't think after that. They can get this loan at the very, holding on with their fingernails, getting the loan, but then they're not bankable for years to come because they're living at that edge. They can't get another loan because of how tight they are leverage wise or cash flow too. You've got to think of all those things.
What would you say that ratio is? Like, I mean, I know Dion's 50, but he's not in growth mode.
Right now, I'm tracking every 6 months. I'll re-update my personal financial statement, and I'm at 61% right now on all of our real estate. And I'm watching every new property that I add. Those are some of the things I didn't put in that video. I was looking at those ratios. Okay, if I put these next two and I'm at 75%, it does move me up. Now, it's not that significant. It really isn't that significant in the total portfolio, but I want to get where that number is going down every year. It is because there's principal pay down. So we do have that feature to it. So it's paying down your loan to value, but I want to stay in that 61 and going lower. So with my next portfolio.
You're at 61. So can I throw some numbers at you? So one property is at 60% loan to value, 200 grand in equity. Another one's 66% loan to value, 100 and whatever it is. And then the last one's at like 85 as the portfolio sits. And then I have a primary that's 50% loan to value, but I'm not sure if the primary comes into play with investments. But so from a banker standpoint, do you think you just take an average of all that, or do they look at that?
It'd be like kind of like it's a weighted average. That's the best way to describe it. So you're putting in all those different properties. You're putting in what it does is it's looking at whatever value is today, whatever that number is, takes your loan balances. So it's weighting them is the best way to describe it. You have to put them all together, and that's where I'm getting my loan to value. It's taking every one of my properties, adding up what the retail value is today versus what my loan balance is today, and that's where I'm getting the 61% loan to value. Okay. So it's not an average of those three numbers. It's taking all those numbers and putting them together. So it sounds from what you're describing, unless that one that's the 85%, you're probably in the 70% range, my guess, if they were all similar value
Well,
properties.
sort of like the one that's the 85%. That's the most, well, actually, it's not, but it's the one I have the most debt on because I didn't put a big down because it was a primary purchase.
So then that's going to weight it up
Yeah,
upwards.
exactly. So, okay. Thanks, man.
But that's a suggestion I'll make when you're going to the banks. Yes, your credit has it and the financials of whatever request is, but they are definitely looking at your personal financial statement more than you know. And I'll sometimes sit down with them and I'll go through everything I'm doing and say, here's what I'm looking at so that they know I am paying attention to what I'm doing.
Oh, crap. I just thought of something. So, I'm doing the velocity banking thing. So my checking accounts, business and personal, are $0 at all times. So that's not good.
They're going to look at that and they will. They'll say you have no runway.
But that's, all of it funnels in because I'm using the HELOC to pay debt, and then all of it funnels to the HELOC to pay it down real fast. But we do have money in the bank, so that and another bank, so that looks good though, right?
Yeah, that looks good, but they are looking at all that. And so I go through it with them and say, here's, I then even if you're looking at it one specific time, it doesn't tell you anything. I look at it over a season, and I was sharing this with my wife the other day. I said, and I'm going to share something with y'all. So I just got into owning investment properties 4 years ago. She was asking how are we doing? And I'm trying to keep her up to date. I said, if we can go back to 2018, our net worth was not even 300 grand. And here we are 5 years later, we're over a couple of $1 million net worth. I said, we've made progress, and the bank sees that, and I'm walking them through it.
When you say net worth, that's your net of your assets under management type?
That's taking every asset we own versus every liability we own.
Wow, good job, man. Yeah, I know we're at like 800K in equity or something like that, and we're at 2.3 million in total assets, but
Because she was saying, well, I don't see it. I said, well, it's in this building here. It's in this building. Yes. Because she was like, we're not saving for retirement. I said, absolutely we are.
Yeah, it's in that building.
It's in that building. And I said, we're not saving anymore. Our renters are.
That's awesome, man. Well, hey, I just saw Steven join. How's it going, Steven?
Hey guys, very well. I haven't had a chance to join any of these. Sometimes with the Ray old guy, but sometimes it pops the time for me on Sunday. So I usually like to hear the crowd around the Zuber. Always you can learn things like that, right? So I was kind of in a mode of preparing myself to pass the elections and everything, and in the coming summer to try to pull out equity on the property. I have a 40 LTV, but I have a very low rate, like 3 point something, right? And I'm just thinking how to
Have you
pull.
checked into a HELOC instead of a cash out refi?
Yeah, I'm thinking about that actually. I'm thinking about that because this is HELOC is I think the way to go, or to put the second mortgage. But it's very difficult to find someone with a second kind of like a mortgage that will give the credit to be second on the debt lien, or how it's ever formulated. So most likely I will have to go with the HELOC, although I'm kind of little bit I never did HELOC before. Like I'm kind of like Dion or whatever. I only like these 30 years products and all of this that I understand, and every time is the same kind of scenario. And then I'm just because this HELOC might be variable or something like that. So that's that's only concern that I have. But as I said, I have a pretty much just 80K on the property that is 210 or around that.
Yeah, so they'll probably give you like 50 or something. Who knows? But but I know that I have a few friends of mine now. I haven't done this, but the HELOCs typically, at least the ones I've seen, they'll let you lock it in at a higher rate. So let's say you get a HELOC, you don't use it, you have it there, and then down the road the rates drop, right? It's variable rate or whatever.
Yes.
You know, because there's somebody in the group, and I won't say their name. They've got a HELOC. I think it's like 4.5 or something locked in. I'm like, son of a. They were smart enough when the rates were like 3 or whatever the hell it was. They went ahead and paid to lock in at that higher rate, and for whatever it was, 10 years or something stupid. So now they're sitting there going, ha ha. You know,
Oh, I see.
so
So
just know that that is a potential. Like right now, they're 8.5. Mine's a variable. It wasn't 9.06. Now it's at 8.5. You know, for what I'm doing, it doesn't really matter that much. But I could lock it in at 11%, or now probably 10 and a half, or whatever it is. So you
I
can
see.
lock it in a lot of cases, I think. But when you're out there researching HELOCs, here's one of the things I found. A lot of these guys, a lot of these lenders will do this weird stuff where, yeah, they'll give you the HELOC and they'll give you, like for me, it was, I think it was really low, like 25% of the equity or something like that. So I got 105K HELOC, said 4 grand, and they said, all right, here you go, but you can, sorry, I just lost my train. Oh, they'll do this weird stuff where they'll charge you like $285 a year to maintain it, and PNC only charges 50. But they'll do this thing when you first do the HELOC. So a lot of them were telling me I had to take an initial draw, right? One of them said 100%
Uh-huh.
initial draw.
Yeah,
Another one said
yes.
50. Another one said 25. And I'm like, dude, that's just dumb. I'm like, oh, just put it back the next day. And I'm like, well, then that's weird. And then if you read the fine print, what I found was the
Yes.
reason why is those guys get paid on the initial draw, right? Like 2%. So that's why. Well, PNC didn't do that. PNC didn't have a minimum draw. They gave me a 30-year amortization and a 10-year draw, $50 a year. I was like, dude, and if I want to cancel at any time, it's like a $300 cancellation fee or whatever the hell it is. So I was like, dude, this is, for me, it was the way to go.
So does PNC, is this Pacific? What
You
is?
know, it used to be, I think, in Pennsylvania, but it doesn't. I think it got bought out or merged or whatever. The PNC really doesn't mean anything anymore. I asked that same question, and that's just the name. It's an acronym now, but it used to be tied to, I think, something in
For the
maybe
bank?
something with a P. I don't remember where, but
Yes. I get bombarded with these Lennar developers that are offering like 4.9, right? For the kind of $350,000 in Spokane, for example, Washington State, where kind of I'm belonging to. And I was really surprised by the rate that they're
but they have
offering.
HOAs, right?
No, this doesn't have.
Really? Oh, wow.
Yes, at least that's how it's presented to me. This one. It
Yep.
was Lennar Homes in
Yeah.
Washington State in Spokane. They're building in the kind of East Washington, because the Seattle in this area is super expensive. This is like a impossible, I think, area. But kind of East Washington is a little bit more still. There is a breeding, so to speak, to some extent.
Cool. Yeah, new
But
home with no HOA at a low rate. Maybe, who knows?
yeah, I mean that was presented. Maybe I didn't catch that HOA. I'm always kind of careful when it comes to signing, but as I said, I kind of spoke with them initially, and I was surprised by the rate, because for rate was 4.9.
And that fixed, or is that like
Fixed rate, conventional.
because for a while there they were doing that, 4.9 the first year and then 5.9 the second year.
Yeah. But that was the other folks, not Lennar. Lennar has a 30 years conventional. I saw also that.
Yeah.
First year, second year, third year, and then kind of like they increased that. Yeah. So I'm just waiting to see when all of this kind of, settles, then probably, next summer to do some of these things. Yeah. It's the way to do, so to speak, at least in my case, because I'm kind of investing from the Canadian side into the US. So it's kind of, allows me to, to do things. But yeah, the main source of information is the Zuber and the Zuber crowd to begin with, in
Lennar does not, or builders do not have the same regulations of people that sell on the resale side. On the resale side, the seller can only contribute so much to a rate buy down, but builders don't have the same regulation. I don't know if you knew that or not, but builders can do buy downs as far as they want to go. And that's why you're seeing that with Lennar, with DR Horton, with the different builders. They don't have those limitations that the resale side does. So that instead of giving discounts on the house, they're doing big buy downs of the rate. And that's the reason why the new construction is still moving a lot of product. They found that they can out compete the resale market because of the rate buy down. That's the advantage they have that the resale market doesn't have.
Yeah.
Yes, but that's absolutely true. But I'm still shocked. Yeah, I mean, 5% compared to what are the rates right now in the Washington State. Like, I have a feeling that everyone will get for the new property. Yes, you have these 350 and above, 400, 450 range, but still, that's not kind of something for the new build. I mean, that's kind of like a really good investment, at least by the calculus. Zuber is calling math, which is a little bit too much. I would say calculus. Just basic calculus can get you, to certainty, because 4.99, this is unforeseen. I never, I cannot imagine. It's very low. That's very low.
Also, a lot of these builders own their own mortgage companies.
Yes, I think the Lennar specifically in the footnote says it is going to be LLC Lennar Bank, something like this. And all of this, they have, it seems, their own mortgage company.
Yeah,
But
look into the closing costs on those. The ones that own their own mortgages, you're paying for it one way or another, I'm guessing. I mean, yeah, they've taken some off their balance sheet, but if you look at those closing costs relative to other normal closing costs, my guess is you're paying more.
oh, okay.
But look at those statements, right?
Statements, yeah. As I said, yeah, it's interesting. It's interesting because it's very difficult to identify right now. I would say market that will cash flow, but that will provide kind of this future value through the cash flow and through some basic appreciation, and that you can buy in. I think like for me, I kind of invest down in Atlanta area because by some chance I knew that. And I live in Texas, but Texas has these taxes. And then I never kind of venture into Texas, although I see a lot of people are doing that. And I know only College Station, where is Texas A&M. I mean, I kind of know by the street because that's the street, that's the school that I finished, and all of this. So this is kind of like I always wanted to go back to Texas, but kind of, never completely resolve this tax issue, because it's kind of like you have to pay a lot of taxes for the property. So, and I'm now looking, maybe some other market. That's why I was thinking of Spokane, Washington, not Seattle, and all of this. Your guys, I know Brennan is in Texas. I saw how he built essentially all of this built to rent and all of this, and it's really remarkable, truly.
I think one of the things that I'm doing, and I haven't shared this in a video yet. So if I look at my earliest builds, my tax rate, and I know what you're talking about because our taxes here are so high, my tax rate was equal to about 15% of rents for the year. These latest ones I'm building, I like them better because it's just outside of city limits. So I don't have city tax in there. And now my tax rate, if I take what I'm building them for, what I'm going to get in rent, it's equal to only about 9% of annualized rents. Well, that's going from 15 to 9 is huge. And that's what's helping my returns is I found these properties just outside of city limits. And there's, it's a big subdivision outside of city limits that's not being annexed into the city. and that's been a big advantage.
Yes. It's outside of the Dallas, right? You're in the Dallas area, right?
Yeah, just outside of Fort Worth, about
Fort Worth,
30 minutes
yes.
outside
Okay.
of Fort Worth.
Yes, yes.
So I'm trying to stay there for at least for right now. Unfortunately, I have one more lot inside of the city limits in the town of Cleburne, but it's zone multifamily, so I will build this out, but it's going to be in that 15% range of taxes of rents, which has hurt my numbers. But I'm going to wait on that one for a little while.
Yes, yes. Oh, these are great. These are great. Yeah, I'm just a classical buy and hold kind of an ad. So this is like
maybe look outside of city limits at properties. I think that's where I'm seeing here in Texas. If you can find properties that aren't in the city limits that still are in demand with rent, that they're outside of city limits, I think you'll see some better numbers.
I see. I love Houston, but I've been through the two hurricanes, so kind of like I never came back. You know, yeah. College Station is my favorite, I have to say. You know.
They beat LSU last night pretty good.
Yeah, I saw that. Yeah, I saw that. This is always big thing in College Station because we are still small compared to the UT, and all of that. But yeah, that's pretty much, with me. Yeah.
But you've got a lot of little towns. If you're talking Bryan College Station,
Bryan, yes, Bryan is next to, yeah, the kind
you're
of.
going up that major highway that goes towards Waco. You've got lots of little towns out there with decent sized towns that you could look at too, and to still be outside of city limits. Because a lot of those towns up in that way, I mean, they're all 5,000 size
Yeah.
communities, but it's highly traveled. I mean, I would say really look outside of city limits. You might see some opportunities here in Texas.
Yeah, I was just going to echo it. I've got properties in Lancaster City, and if I go a mile east, like my tax burden drops by more, and I'm beginning to wonder, at the way the tax rate's growing, if that may be something I get forced to do in the coming years.
Yeah.
Well, cool deal, guys. I need to start wrapping this up. I know I normally don't do that. I usually go longer, but I've got some family stuff I need to get to. So unless
Okay. Thank you guys thank you. Great advice. Thanks.
Awesome, guys. Well, hey, thanks.
Thank you, gentlemen. Really appreciate the ear
Thanks,
candy while I'm catching fish.
Did you catch anything?
Oh yeah, pulling it up right now.
Nice. All right, guys. Well, I'll catch you guys next time.
Cheers.
Cheers. Oh, nice.
Bye-bye.